Hi, welcome back to this chapter 10 of the Little Book of Valuation. And in this chapter, I want to focus on financial service companies, what makes them unique, what makes them different from valuing any other company. When you talk about financial service companies, they run the gamut because each financial service company or type of financial service company has a different kind of business model. Let's take an old-fashioned bank. How do banks make money? They make money off the spread. What does that mean? They pay interest on deposits or debt that they take on. They lend it out at a higher rate. They make money on the spread. So banks make money on the spread if they're traditional banks. What about insurance companies? They collect premiums from us to basically manage our risk. And if we have a problem, our house burns down or you lose our lives, they pay out. So if you look at insurance companies, their premiums have to exceed what they pay out on the claims made on them. What about an investment bank? At its core, an investment bank provides advice and gets paid for that advice, supporting products, and most of all on the deals that come out of companies that use their services and the deal fees. And traditional investment firms, who basically manage other people's money, they provide investment advice and they get paid either based on the assets under management, the amount of money they manage, or by charging people direct fees. So when you sit down to value a financial service company, the first thing you need to do is figure out what type of financial service company it is and how it makes money. Now, if you look at the commonalities that these companies share, there are a few. First is, if you look at financial service companies, most of them are regulated because there's a side cost to society if they go under, and that regulation is often tied to the book value of equity. Put simply, banks and insurance companies are required to hold a certain amount of book value of equity in case something bad happens, a big loan goes bad, or a big payment has to be made. Second, most financial service companies are constrained in where they can invest. This was a post-Depression rule in the US where banks after the Great Depression were not allowed to go out and invest in traditional businesses and take on risks that could not be managed. For a while, they eased the rules, but after 2008, many of these rules have come into play again. And third, many of these businesses, if you look at the way they're structured, the regulatory overlay is very strong. It's not just something on the side, but it's central to how they do business. And the accounting rules are often different across these companies as well. In many of these companies, unlike traditional companies, there's a mark-to-market convention for much of what you have in the books. And much of what these companies have on their books are financial assets, stocks, bonds, investments, loans, things that can be marked to market fairly easily. So those are the commonalities in spite of the different business models. In terms of valuation issues, there are two big ones. The first is, with traditional companies, we talked about a cost of capital. We said capital can come from both debt and equity, and we took a weighted average of those costs to come up with the cost of funding the entire business. Now, debt to a bank or a financial service company is not capital, it's raw material. What do I mean by that? You borrow money at 4%, you lend it out at 6%. Debt becomes the raw material that you use to run your business. Therefore, when you value a bank or an insurance company or an investment bank, you have to stay focused on equity. There's no such thing as cost of capital or enterprise value. Or if there is such a thing, it doesn't have much meaning. So stay focused on equity because debt is raw material. Second, even staying focused on equity, estimating cash flows to equity. Remember the free cash flow to equity computation? Where you took the net income, you subtracted out reinvestment, which included change in working capital and net capex, and then debt payments and debt issuances. Really difficult to do for a bank because, again, what's capex, what's working capital, very difficult to get your hands around. So debt is raw material, so therefore you stay focused on equity, and estimating cash flows to equity are difficult. Saying, where does that lead us? Very simply, to the dividend discount model. The dividend discount model is the oldest discounted cash flow model in practice, and increasingly it's been abandoned in most aspects of valuations. But financial service company, it has remained in place partly because of desperation. If you decide to value the equity in a bank and you cannot get free cash flow equity because you can't get the capex and the working capital numbers, you know what you do? Use dividends. The dividend discount model essentially says that the value of a bank is the present value of the expected dividends you will receive on that bank. In fact, if it's a stable growth bank, you can use the Gordon growth model, a stable growth dividend discount model, where you take the expected dividends next year and divide it by the difference between the cost of equity and the growth rate. If you look at the dividend discount model, there are three sets of inputs you need to get the dividend discount model off the ground. The first, you need a cost of equity, which would be higher for riskier equity and lower for safer equity. The second is you need to estimate the proportion of your earnings that you assume will get paid out in dividends. Rather than focus just on the dividends, focus on the proportion of earnings that get paid out in dividends. And here's what. You might have a company, a bank that is high growth, that is paying out a relatively small percentage of its earnings as dividends right now. But as the bank gets to be a more mature company, that proportion should go up. So you need a cost of equity. You need to estimate earnings and the proportion of earnings that will be paid out in dividends. And finally, you need an expected growth rate in earnings and dividends to get to value. So with that in place, let's think about a bank's cost of equity. And what I say about banks, you can generalize to other types of financial service companies. The conventional practice in valuing banks is to use a sector average beta and leave it at that. Now, if you remember, with traditional non-financial service companies, you took out the effect of debt, unlevered that beta, and then re-levered it back up. We're skipping that step for banks for a simple reason. Remember we said debt is raw material and defining what debt is in a bank is a nightmare, so we give up. So for the longest time, we used the same cost of equity for every bank. But there are two issues that increasingly we've had to confront. The first is, remember we talked about regulation and regulatory capital? You can argue that a bank that has more regulatory capital is safer than one with less regulatory capital. That maybe we need to adjust the cost of equity for how capitalized a bank is. And if we have any sense, we should also be adjusting the cost of equity for the fact that some financial service companies expand into riskier businesses. Many traditional commercial banks in the 1980s increasingly turned to investment banking, trading, securitization, real estate to get higher growth, but in the process they created more risk for themselves and higher betas. The second is you could argue that higher growth banks are inherently more risky than lower growth banks. Why? Because for growth, you got to go into new markets and new businesses, exposes you more to risk. So at least in theory, you could argue that even though you cannot unlever and relever betas, you should be able to adjust the betas for how risky banks are in terms of their core business and how much they're growing. So let's try this on a bank. I'm going to value one of the largest banks in the world, Citigroup. And I'm going to use a traditional dividend discount model to start the process. Now, rather than start with the beta and build up to a cost of equity, I'm going to try a different tactic. Now, because betas have become so messy with banks, especially this was done in the aftermath of the Silicon Valley Bank disaster in the US, and the betas might not reflect that risk, here's what I did. I took all banks, in this case all big banks. I came up with their price to book ratios for the market. I also looked up their return on equity in May of 2023. So the median big bank in May of 2023 was trading at 1.04 times book value, and its return equity was 12%. Let's set the growth rate equal to the risk-free rate, a practice we've used in other aspects of valuation as well. Collectively, if you think about big banks as being mature businesses, and they should be, right? These are big banks. That price to book ratio can be written as a very simple equation. And this is an equation you can derive from a basic dividend discount model. It's the difference between return on equity and growth in the numerator and cost of equity and growth in the denominator. Let me say, how does that help me? You know the price to book, you know the return equity, you know the growth rate, right? The only thing you don't know is the cost of equity, and a solve for the cost of equity. The cost of equity for a typical big bank in the US in May of 2023 was 11.67%. This is actually a way of getting cost of equity for companies that's model agnostic. There's no risk-free rate, beta, risk premium, all the things that worry you about traditional cost of equity. It's based on how the market is pricing banks collectively. I'm going to use that as my cost of equity for Citi. Now notice, when you talk about dividends, you got to bring growth into the equation. For the same reason, when you talk about cash flows, you have to talk about growth and reinvestment. In general, banks that pay higher dividends will grow at a lower rate because they're reinvesting less. And if you remember, we actually came up with an equation for growth in earnings as a function of the return on equity that a company earns and its retention ratio, what doesn't get paid out in dividends. So if you take your growth rate and your return equity, you can actually derive a payout ratio that's consistent with those numbers. So here's what I'd like to do. Now, into May of 2023, Citi's return on equity was 8.78% in the trailing 12 months. It paid out about 29% of its earnings as dividends in the last 12 months. If you take those as steady state, and you can contest that, you can say that's not right, it's too low, too high, but let's take that as steady state. Their expected growth in earnings per share is about 6.22% as long as they maintain that retention ratio. So I'm going to use a 6.22% earnings growth rate to get expected earnings in the future, leaving the payout ratio at roughly where it is, 29.11%, very close to 29.14%. I get expected dividends. So basically my net income grows at 6.22%. I pay out 29% of that as dividends. My expected dividends reflect that constant payout ratio. I have my expected dividends for the next 5 years. You're saying, what happens at the end of year 5? Well, by now you know what's coming. At the end of year 5, I make Citi into a mature company. I give it the growth rate of 3%. I assume the cost of equity stays at 11.67%, that its return on equity remains at 8.78%. Now, why do I need a return equity? To grow at 3% a year, if I have a return equity of 8.78%, I can afford to pay out about 66% of my earnings as dividends. So in year 6, to get my dividends in steady state, I take my expected net income in year 6, I multiply it by my payout ratio, and I divide by the difference between the cost of equity and the growth rate. I come up with an expected value of equity, a terminal value of $157 billion. On a dividend discount model, that's what Citi will be worth at the end of year 5. I discount the projected dividends and the terminal value back at the 11.67% cost of equity. I get a value per share of about $56, higher than the stock price of 46 at the time. Very simple dividend discount model. You are inherently assuming that Citi is paying out what it can afford to, that it can maintain its existing return equity, which is not a great return equity. It's lower than the cost of equity in perpetuity. That's a dividend discount model. And until 2008, that's where I would stop. But in 2008, we were faced with a banking crisis, and we discovered very quickly that you could not trust banks to pay out what they could afford to in dividends. There were banks that had terrible regulatory capital problems that continued to pay dividends. So I started thinking about how would I estimate the free cash flow to equity for a bank, which led me to a follow-up question. What exactly is reinvestment for a bank? It's not the capex of a manufacturing company. It's not the working capital that a retail company. So what does a bank have to reinvest in to grow? And I went back to the regulatory capital base. Remember, for a bank to grow, it has to maintain a regulatory capital ratio. Otherwise, it'll be shut down. I said that reinvestment that a bank has to make in regulatory capital becomes its equivalent of net capex and reinvestment. So I'll give you a simple example. Let's assume you have a bank, and it's a small bank, a traditional bank that makes, has 100 million loans outstanding right now, book value of equity of 6 million. Let's assume that this bank is expected to make 5 million in net income next year and would like its loan base to grow by 10% next year and maintain its and increase its regulatory capital. From the 6% it is right now, I'm assuming regulatory capital and book equity measure the same thing, to 7%. So let's see what we have. Next year's net income is 5 million. Right now the bank has 6 million in book equity / regulatory capital, but next year I want that number to be 7.7 million. I'm going to subtract that the 1.7 million in reinvestment from my 5 million. My cash flow to equity is 3.3 million. This is my potential dividend. Now, of course, this example is very simplistic. You say, how would I extrapolate this to a bank? I tried this for Citi, and here's what I did. I started with the risk-adjusted asset. Sounds fancy, but this is a regulatory term that banks report. And if you see, Citi has risk-adjusted assets of 1.14 trillion. Their existing Tier 1 capital ratio, again a regulatory term that they refine, is 14.8%. That's actually a pretty healthy number. I'm not going to assume a huge increase in that number. I'm going to assume they're getting more conservative, partly because of the Silicon Valley Bank, and that ratio is going to go from 14.8 to 15%. The return equity right now is 8.78%, but let's say in this model, I'm more realistic and assume that over time, they will be able to improve that return equity to 9.5%. Still not high enough to cover the cost of equity, but better than today. Here's what I do. I use my expected return equity times book equity to get my net income each year. So my net income increases over time. To get to potential dividends of free cash flow equity, I estimate the regulatory capital each year. So if you look at my regulatory capital, it's basically my Tier 1 capital ratio times my risk-adjusted assets. So basically, there's my Tier 1 capital. The change in the regulatory capital from year to year becomes the equivalent of my investment. I subtract that out, I get to free cash flow equity. My free cash flow equity is $10.7 billion next year, and it grows over time. At the end of year 5, I do the conventional thing, which is stop the growth, assume a stable growth rate in perpetuity, and compute a terminal value. And I discount those cash flows back to today and divide by the number of shares. The value per share I get is $69. If you remember, the value that I got with the dividend discount model is 57. You're saying, why is it higher? Two things. One is I don't think Citi is paying out what it can afford to in dividends. That a lot of the cash it's retaining is just being held as cash for safety. I'm not saying it's a good thing or a bad thing, but I'm understating value with the dividend discount model. I'm also not factoring in the reality that Citi is a well-capitalized bank. You're saying, where would that play out? If Citi's Tier 1 capital ratio had been 11.8% instead of 14.8%, been undercapitalized, it would have had to reinvest much more regulatory capital to get to 15%, which would have reduced my cash flows. A free cash or equity valuation of a bank captures what a bank can afford to pay out. It also captures how well capitalized a bank is. In my view, it gives you a more realistic value of equity in a company. As with the dividend discount model, at the end of year 5, I put this company into stable growth. I assume a return equity of 9.5% a year forever. And that's higher than the 8.78%. So that's the third reason why my value per share is higher. And the value per that I get at the end of year 5, my terminal value is $159 billion. So part of the improvement is coming from the improved return equity. Part of it is from being more realistic about the cash that can be returned. And part of it is bringing the regulatory capital into the picture, a fuller picture of what a Citi is worth. So there's the dividend discount model. There's this free cash flow equity model where reinvestment is defined as investment in regulatory capital. There's the third approach to getting the value of equity in a bank. Now, you can actually write the value of equity or value of the firm for any firm as the current value for the equity, the book value, plus the present value of excess returns you're going to earn on that equity invested. So you've got $100 million invested right now, and you need to earn 10% on it, but you're earning 12%. You're earning a 2% excess return. The value of equity today is the equity capital invested, the book value of equity, plus the present value expected excess returns to equity investors. Okay? The two key inputs in the excess return model are the return equity and the cost of equity. The equity capital is the equity capital, it's just book equity. If I tried this for Citi, you can already see where this is going to lead me to. The book value of equity at Citi was $182 billion. But remember, the return on equity for Citi was well below the cost of equity, both in the dividend discount model and the free cash flow equity model. My excess returns are actually negative. If I take the present value of those negative excess returns, my expected market value is going to be lower than the book value. So in this case, I come up with $109 billion I come up with the market value below the book value, which is consistent with what I got both in the dividend discount model and the free cash flow equity model. It's the same driver. Ultimately, financial service companies will be judged on their capacity to generate return on equity relative to their cost of equity. If you earned roughly your cost of equity, you should trade at book value. If you're expected to earn below your cost of equity, you will trade at below book value. And the excess return model makes that explicit. Talk about pricing banks. Now, if you think about the pricing ratios, again, if you remember the start of the session, I said you've got to be equity focused, which means the only multiples you can use to judge banks have to be equity multiples. If you ever see somebody using an enterprise value multiple for a bank, walk away because it doesn't make sense. And if you think about the most widely used equity multiples, you can use a PE ratio for banks and compare PE ratios across banks. And a low PE ratio bank is cheaper than a high PE ratio bank until you start asking questions about growth and return on equity and risk. With a price to book, same thing. The price to book ratios for a bank actually make particular sense because the book value is marked to market and has financial assets. And a bank can't just write down book value by, if it feels like it, because it can affect its regulatory capital. The price to book ratio is more widely used with financial service companies than any other groups precisely for that reason. So you can compare price to book ratios across banks, but there again your focus should be not just what the price to book ratio is, but also the other factors. In particular, the return on equity has to come into play, and perhaps even the regulatory capital ratio. In fact, you can see why the two didn't come into play. Banks with higher returns on equity should trade at higher price to book ratios, other things remaining equal. Banks with higher regulatory capital ratios should trade at higher price to book ratios because they're less risky. So with Citi, here's what I did. I looked at the price to book ratios for Citi versus JP Morgan, the 25 largest banks. Let's start with the slam dunk number. Citi looks incredibly cheap. It trades at half of book value. JP Morgan trades at 1.5 times book value, and the typical large bank trades at 1.04 times book value. You're tempted to go out and put all your money in Citi, right? But before you do that, there are a couple of other things to factor in. One is Citi is growing slower than JP Morgan or the median bank. It grows at 3.7%. Big banks are growing at 10 to 11%. Citi's Tier 1 capital ratio is solid, but it's actually a little lower than JP Morgan's and the typical bank. So Citi has lower growth, slightly lower regulatory capital ratios, and definitely worse returns on equity. There's a reason why the price to book ratio is lower for Citi. Does it justify paying half a book value? Well, you can try what we did in previous chapters where we actually run a regression of price to book ratios against return equity and maybe Tier 1 capital ratios to see how Citi looks. But when you price banks, it's imperative that you go past by the price to book and ask questions about growth and regulatory capital and return equity. I hope you found this session useful, and I thank you very much for listening.